When you own a rental property today, it's largely break even on cash flow. We've talked about this openly for years now, right? You're not getting rich because of rent, net rental income, right? But what you're doing is you're creating an asset that over time is going to grow so that the cash flow is there when you need it, right? If we're talking about potentially selling a property because in 15 years you think a maintenance cost is coming your way, it makes even less sense when you put yourself into the financials of how this rental property is going to look in year 15.
So we're going to go over the projections of what it looks like and how you make this financial decision. But first, we got to give a little bit of advice here, right, GC?
Yeah, absolutely. Just a call to everybody before you think about actually putting your money with any financial institution. Make sure you do your own due diligence. I'm going to be sharing some numbers here. And, of course, these are estimates and are not guaranteed. And you should do your own due diligence. There's different ways of calculating different returns on investment. This is the one that makes the most sense and is generally accepted. But above all, we're not a financial advisor. We're not offering financial advice and or planning. And with that, let's get into it.
Yeah. Gee. So as you were preparing for this, I remember you telling me that the first thing that people really need to understand for them to like make this decision isn't like how you compare this to the expense. It's really understanding how much wealth you are building year over year in this asset. So first, you put together this idea of if things start to need these big expenses somewhere around year 15, let's talk about what we are gaining year over year in these types of years. You want to talk us through this?
I do. And I think there's two things that really should jump out to people, or maybe two areas where there's just a lack of understanding from, average investors out there. When we're talking about a major maintenance item coming your way, all people are focused on is call it that $7,000 expense hitting my bank account right now. But many average investors lack the understanding of how rental properties actually pay you 5 ways. And they don't understand things like tax savings or principal pay down, or even how home price appreciation works. And we didn't even factor inflation hedging and inflation profiting in here, but that would be the fifth profit center. So people aren't even aware that these other ways pay you. And then they're certainly not aware how much these other things pay you as well. These other profit centers, many of them are hidden though. So there's an emotional component to that $7,000 roof cost. Let's just use that as an example because $7,000 has to be paid today and that's my bank account. But what we have to do is to understand all of these other things that are creating your wealth in that year. And of course, over the long haul is why we hold these properties for a full market cycle like we do.
Love it, man. So talk to us about how we understand it. We want to start at year 14. Why'd you pick year 14?
Well, I'll go back and tell you how I built this. So in my head, I'm like, okay, let's take a client who is buying a home today. And maybe they heard or they read or they came up with it themselves that, you know what, I know that things are going to break. And at 15 years, I'm going to make a plan that I'm going to sell this home somewhere around year 15, because I think that's when my roof is going to go. And so what I did was I said, okay, well, let's use this planning tool. Let's use this real estate investment planning tool that we offer, that we do for all of our clients. And let's actually model this out. So let's see how much from all 5 of these profit centers we're actually earning in the years that are surrounding year 15. And so all of the numbers that I'm going to share with you are built off of buying a property at today's average purchase price, which is right around $240,000 for a JWB property, with today's interest rates and using financing from today. And I started to model that out. And so if we want to go ahead and pull those numbers back up for year 14, that property that was purchased, call it today, in 14 years, the net rental income each year will be over $4,500. And that's assuming that rents go up year over year like they have for the last 30 plus years in Jacksonville. So using those very solid assumptions there, That's also assuming that you have maintenance costs and vacancy costs happen every single year, like they do when you own rental properties, or at least they don't happen every year, but you should at least plan for that amount of money to be spent for those over the long haul. So it's all included there. Your net rental income is over $4,500. Let's just start there, Pablo. Does that number seem high to you?
Yeah, yeah. It definitely seems like a pretty high
Yeah.
number, like higher than when you're normally buying it, right? Like I am right now in a scenario where I have 3 properties that I've held for coming up on, getting into year 3. And the total net rental income that I'm getting from my 3 properties is somewhere around that like $500-600 a month. Right. So to think that one property, $4,500 a year, that is starting to illustrate this idea that cash flow goes up over time as I hold on to these things.
Absolutely. Absolutely. That's what's happening. Rents are growing 3.6% per year, and the majority of your expenses stay the same. So your cash flow grows. By year 14, you're making $4,500 in net rental income, which is surprising. I don't think many people realized that your cash flow grows that much. That's one of the reasons why we talk about how break-even cash flow when you buy the property is the goal. It is the goal because it's going to grow over time. Don't get so hung up on, do I have an extra $25 a month of cash flow here or there, or an extra $100 here? Don't sacrifice a great team or a great market in search of cash flow, because your cash flow is going to be there. The market and the rents are going to grow.
Pretty sweet. All right, keep talking us through it.
Yeah, so then that's the noticeable profit center, right? And if we're talking about $7,000 of an expense potentially coming this way, wow, you have $4,500 that you're just earning from net rental income, which is very visible in your bank account. Now we can go to these other profit centers that aren't so visible. Your tax savings, the amount of taxes that you don't have to pay because of this asset class, is almost $3,000 for just that year in year 14. Then we can go to principal paydown. This is the amount of your loan that is being paid down by your resident in this one home. They are contributing $4,000 of profit to you by paying your loan down for you. Number's actually $3,767, almost $4,000, and you never even noticed it. It's because your loan balance is going down. And then there's the biggest profit center of them all, which is home price appreciation. And over Jacksonville's history, home prices have appreciated on average 5% per year. That's going back since 1982, 5% per year. I scaled that down a little bit because we like to underpromise and overdeliver, and we do this in all of our evaluations. So I assumed that home prices were actually going to grow 4.8% per year. And that equates to over $21,000 in home price appreciation. But you never feel it. You never see it in your bank account, because that's not the way this asset works. The beauty of this asset class is built by holding, and you don't always see it. It doesn't always hit your bank account at that time. But when it does hit your bank account, it's very, very large. So your total profits earned from all of these profit centers in year 14, over $32,000. And that's what happens when you have an asset that grows 3.6% in rents each year, and home prices grow 4.8% each year, that you get tax savings and principal paydown, and you're earning, call it roughly 10% a year. That means you're really earning $32,000 in year 14, according to assumptions that have stood the test of time.
Do you see, when I look at these numbers and I think about the idea of, if I know I have a maintenance expense and I know this is happening just in 1 year for me, right? And I'm thinking to myself, golly, I gotta come out of pocket 10 grand, for a roof. Let's call it 10 grand, right? Just like an easy, high, scary number. If I know this is happening, it's a very different equation, right? Like I think of in my earlier days of being a green building consultant, I was in this like 52-story, like tall mixed use building in downtown Miami. And I did some research on it. I, like tested some things, and I realized that if these folks spend $750,000 a month in electricity, and
Wow.
yeah, it's insane. And I was like, for about $1 million, you can do a project that is going to save you around $500,000 a month in electricity, right? And
Wow.
they're like, wow. You know, if you think about it, I'm like, hey, here's $1 million to spend. But for them, total no brainer to think, oh, well, okay, well, if I'm going to do that, then, you know, yeah, I'm going to lay out $1 million. But if I'm going to save 500,000 one year, 500,000 the next year, from there on out for the life of this building, like that's just like a cash cow
Sign
for
me
them.
up.
Yeah, sign me up. Right. So to me, that's what I think of here. I think of, and this is completely inverted, right? Like this is like, if I want to spend $10,000 to make 32 grand a year, it starts to become like a real no brainer of, do I spend $10,000 one time to get paid $32,000 in net wealth for the next 15 years? Starts to be pretty obvious. But I think what's going to be really interesting is that year 15, it's actually even more.
Mm-hmm.
Right. And then year 16, it's even more, and it continues down the line. So it's not even like considering, do I spend $10,000 right now to make $32,000, you know, a year off of that 10 I spent, but it's like an increasing number that continues to go on. Cause if you're listening on the podcast, what we're showing is in year 15, then that rental income goes up, everything goes up so that it's, the total profit is not 32 like it was in 14, it's 34,000. And then in year 16, the total profit is 36,000, and that continues down the line. That's essentially what we're showing here, is showing people what you make every year so that you can compare that to like a one-time cash outlay, right?
Yeah. And I'd love to hear from the community. I mean, sometimes when I put these forward projections together, I stop myself and I go back and I check the numbers 3 times, 5 times, because when you start to see what the profitability of a single rental property is based on proven assumptions that have stood the test of time, the numbers start to get really large. I'd love to hear from the community. Did you guys think that in year 14, if you buy a rental property today, in year 14 of owning that you're going to be making 32 grand on that rental property? Like,
Yeah.
those are real numbers. Those are real numbers. The thing is, and this is a challenge for all investors out there and people in general. People have a hard time handling their emotions, and they have a hard time planning for cash flow. And it's definitely beyond investors we're talking about here, right?
Yeah.
Emotions and cash flow. But if you can master your cash flow, prepare your cash flow appropriately, which we help all of our clients do through maintenance escrows and reserves that we talk about. So if you can master your cash flow, you can be in the game long enough. And if you can handle your emotions, you can be in the game long enough so that in year 14, you can make 30 grand on an investment that you probably put $75,000 into, right? That's the same, investment that you just talked about for the $1 million example, saving 500 grand a month, right? It's not as good as that because that was a month, but this is a year, right? If you could put out $75,000 and make $32,000, that would be a great investment for you, right? Well, this is what it starts to do as you hold on longer and longer and longer for your rental property portfolio. You just have to manage your cash flow so you can stay in the game long enough, and you have to manage your emotions so you can see the beauty of all 5 profit centers.
Love that, man.